Ever wondered how institutional traders spot the right supply and demand zones? If you're watching this, you want to trade like they do and find those key zones before they enter. So in this video, I'll show you 8 simple rules to find those zones. Trust me, this will work. Let's get started. Let's start with the first rule. The zone must lead to a break in market structure. Think about this. When price is moving upward, forming higher highs and higher lows, that's great, right? But what really matters is when price actually breaks a previous significant high. That's our break of structure, or BOS for short. Now pause. Ask yourself, what was the last point on the chart where buyers stepped in and drove price up to break that structure? That's your demand zone. Why? Because it takes serious money, institutional volume, to push price past key levels. So the zone that caused that break, it holds weight. It's not just noise. It's a clear sign that big players were active. Alright, let's break this down on a real chart. Exactly how I look at it when I'm planning a trade. You can see here we're in an uptrend. Price is making higher highs and higher lows. Now watch this. Price pushes up and breaks above that previous swing high. That's a clear break of structure. So what do we do next? We just look back and ask, where did that move start from? That's our demand zone. That's where the buying pressure came in strong enough to break structure. Now from here, we don't chase the price. Instead, we wait patiently for it to come back into the zone. When it does, we watch closely to see how it reacts. If the reaction looks good and we get the right kind of confirmation, that's our cue to step in and take the trade. And don't worry, I'll be walking you through exactly how I enter trades and the specific confirmations I look for when price returns to a zone. So stay tuned, because we're going to break it all down, step by step. Alright, let's move on to rule number 2. And this one's a game changer. We're talking about what traders call a flip zone. And trust me, once you understand this, spotting solid entries gets way easier. So what exactly is a flip zone? Well, it's when a level that used to act as supply flips and starts acting as demand, or vice versa. And here's why that matters. At first, supply is in control. Price hits that level and gets pushed down. But then, something changes. Price comes back up to that same area. And this time, supply tries to hold again, but fails. That failure is what we're watching for. Why? Because demand steps in hard. It absorbs that selling pressure and drives price higher. That's the flip. What was supply now becomes demand. And that makes it a high probability zone for long trades. But here's the catch, and it's important. Don't just assume a flip happened. You need to see that clear battle between buyers and sellers. Wait for the signs. That supply failed, and demand took over. Once you've got that confirmation, then you're working with a real tradable setup. Now, let's take it to the charts and see how this actually plays out in real price action. So, here's what we've got. The market was in a downtrend. Supply was clearly in control. Price broke structure to the downside, and a new supply zone formed. Then price pulled back into that fresh supply zone and tried to push lower again. But here's the key. It couldn't break that previous low. Instead, we saw something important. Demand stepped in strong, and when that happened, the story changed. Price flipped direction, broke structure to the upside, and just kept climbing. That right there is a textbook flip zone. So, what's next? Simple. We mark that zone. Why? Because if price pulls back into it and we get the right confirmation, that becomes our high probability area to look for longs. Clean, precise, and powerful. As long as you're patient enough to wait for that clear failure from supply and real strength from demand. Let's break down sweep zones with a simple example. This is a powerful way to spot where the big players are making their moves. Imagine price is trending up, but during a pullback you notice a series of equal lows. This is important. Why? Because those equal lows are where traders are placing their stop losses. And we know that stop losses are just sell orders waiting to be triggered. Now, here's where it gets interesting. Big institutions need liquidity to make large moves, and those stop losses are the perfect spot to get it. So they push the price down, triggering those stops and flooding the market with sell orders. Once they've got all that liquidity, they step in with massive buying power, causing the price to reverse sharply. This quick dip and reversal is what we call a sweep. But here's the key. We don't just jump in right after the sweep. First, we want to see price break above the previous high to confirm that momentum is shifting. Once we see that, we can mark the zone where the sweep happened. That's when we wait for clear confirmation before placing our entry. Alright, let's break down sweep zones in action with a real chart example. So here's what we're looking for. Price is moving up, right? Making those higher highs and higher lows, everything's looking good. But then, price pulls back and starts forming a series of equal lows. This is important. Those equal lows are where retail traders are placing their stop losses. Think of it as a bunch of orders waiting to be triggered. Now, here's where the magic happens. Price dips below those lows, triggering all those stop losses and flooding the market with sell orders. But notice something. Price doesn't keep going down. It quickly reverses. Why? Because big institutions are stepping in, grabbing that liquidity to buy in large quantities with minimal slippage. Now what do we look for next? Once price shoots up and breaks the previous high, we've got confirmation that demand is strong in that zone. From here, we mark the zone where the sweep occurred, and we wait. When price comes back to that area and reacts, that's your cue to enter. Simple, right? This setup works consistently. Just keep an eye on the price action. Alright, let's talk about rule number 4, inducement. This one's crucial to understand if you want to avoid getting caught in false zones. So, what exactly is inducement? It's the concept that there needs to be liquidity sitting in front of a zone. Essentially, institutions need to find liquidity they can trade against, meaning they need enough stop losses, buy orders, or sell orders to create a reason to move price. Let's break it down with an example. Imagine price moves up, then pulls back, creating a small low. Early buyers likely jump in here, building sell-side liquidity just beneath that low, meaning stop losses are sitting there. Price then pushes through, grabs all that liquidity, and that's inducement at play. It induces traders to act too soon and stops them out. Once that liquidity is grabbed, the real demand or supply steps in, and we see the big move. The key takeaway is, if there's no liquidity sitting in front of a zone, chances are it's not a valid level, and price will just blow through it. So always ask yourself, is there liquidity to grab here? If not, don't trust that zone. Let's take a look at a real chart to see inducement in action. Watch closely here as price is trending upwards, forming higher highs and higher lows. Then, we see a small pullback, and price forms a minor low. This is key because early buyers are likely entering at this point, placing their stops just below that low. Now, this is where inducement comes into play. Price drops just below that low, grabbing the liquidity below it. It sweeps the stop losses, triggering them, and then immediately reverses with strength. That's the inducement move. So, why did price react so strongly from that level? The reason is simple. Institutions needed that liquidity to fill their buy orders. They used those sell stops to enter without slippage, and once those orders were filled, price shot up. This is why we don't just blindly enter zones. We wait to see if inducement has been created. If it has, the zone is more likely to hold. If not, there's a higher chance it'll fail or get swept. Alright, let's talk about rule number 5. Stacking zones across time frames. Here's the idea. Let's say you spot a demand zone on a higher time frame, like the 4-hour chart. Now, imagine you also see a zone forming in the same area on a lower time frame, like the 15-minute. That's what we call stacking, and it makes the zone stronger. Why does this work? Well, institutions and larger players usually operate on those higher time frames. So, when you have a zone on a lower time frame that lines up with one on a higher time frame, you're aligning both short-term and long-term order flow, and that boosts the chances of price reacting from that level. It's simple. More confluence equals more confidence, and more confidence means better probability. Always look for these stacked zones. They give you a stronger edge in the market. Here's a real chart example to show you how this stacking works. On the left, we've got the daily chart, and you can clearly see a demand zone where price made a strong move up. Now on the right, we've zoomed into the 4-hour chart. You'll notice that price creates a 4-hour demand zone right inside that same area from the daily chart. That's what we call a stacked zone, a perfect example of confluence. When you see this, it means the zone isn't just important on one time frame, but on multiple. This usually indicates that more orders are resting there, which makes the level more likely to hold when price returns. So when price comes back to this area, that's when we can look for confirmation. Stick around, and I'll show you exactly how to confirm this setup and enter with confidence. Let's talk about alignment with higher time frames, which is rule number 6. This one is crucial. The more time frames that are in agreement, the higher the probability your trade will work out. Essentially, you're stacking the odds in your favor. Check this out. On the M5 chart, we see what looks like a clean bearish trend, and you might be thinking, this is a great setup for a sell. But when you zoom out to the M15 chart, the story completely changes. Now, you can see that price is actually bullish on the M15, and it's just come down to mitigate a demand zone at a strong M15 low. So, even though M5 might look bearish, it's reacting to demand on the higher time frame, and is likely to switch bullish. That's why multi-time frame analysis is key. Higher time frames have more influence because they represent bigger money and more traders. If your lower time frame idea goes against the higher time frame, you're fighting the bigger flow. Aligning with higher time frames helps you avoid false signals, reduce losses, and stay on the right side of the move. Alright, let's break this down on a real chart. We're starting on the M5 time frame. Price is clearly moving down, making lower highs and lower lows. It looks like a solid sell setup, right? But hold on, don't jump in just yet. Now, let's zoom out to the M15 chart, and here's where everything changes. you'll see that price has just tapped into a strong M15 demand zone, and guess what? This zone hasn't been violated yet. That tells us the higher time frame is still in control, and it's actually bullish. So what happens next? Instead of continuing lower, price respects the M15 demand zone, and the M5 structure starts flipping bullish too. This shift can surprise a lot of traders who are only focused on the M5. That's the power of alignment. By making sure your lower time frame setup agrees with the higher time frame, you avoid being caught on the wrong side. You're not just trading a setup, you're trading with the flow of time and capital behind it. Let's talk about rule number 7, well-priced zones. This is all about entering trades at the best possible levels. For demand zones, you want to buy in the bottom 50% of the overall range. That's where price is considered discounted, and where institutions are more likely to step in. For supply zones, you're looking to sell in the top 50%, where price is expensive and sellers are active. This approach gives you better risk to reward. Buying low and selling high means your stop is tighter, and your target has more room to play out. It also puts you in sync with institutional order flow. Here's how it works in a trend. In a downtrend, price pulls back to premium levels, the upper half of the range, where we look to sell. In an uptrend, price retraces to the discounted lower half. That's where we look to buy. The key is simple. Well-priced zones increase your edge, reduce risk, and improve trade quality. All right, let's move into the 8th rule, fresh versus mitigated zones. Let's say we're in a downtrend, and price just formed a supply zone. If that zone hasn't been touched yet, we call it fresh or unmitigated zone. That's important, because it means the original institutional sell orders are still sitting there, unfilled. So when price comes back, those resting orders are likely to get triggered, and that's what usually causes a sharp move away from the zone. Now, if that same zone had already been tested once or twice, a lot of those orders are probably gone. The reaction won't be as strong, and in some cases, price might just break through it. That's why fresh zones are high probability. They still hold full order flow. Now take a look at this example. Here's a supply zone that hasn't been touched. It's completely fresh. When price comes back, the reaction is aggressive, because those institutional sell orders are still waiting. Now compare that to this zone that's been tapped multiple times. The reaction is smaller, less decisive. That's what happens when the zone is mitigated. Focus on unmitigated zones. When combined with structure and timing, remember to combine all 8 rules to find institutional demand zones. They will give you the highest probability trades. Let's talk trade management, the part that turns a good setup into a winning trade. Starting with entries, there are 3 reliable methods you can use around supply and demand zones. The first is the limit order entry. This one's straightforward. Place a buy limit at a demand zone or a sell limit at a supply zone. It gives you the best price, but there's no confirmation. That means higher risk, but also higher reward. This method works best when the zone aligns with the higher time frame trend and shows strong imbalance. The second entry type is the change of character. This gives you confirmation. After price pulls back into the zone, wait for a clear shift in structure on the lower time frame. That's your signal. Once you see that shift, identify the low or high that caused it, and enter at that level. Place your stop just beyond that structure. This method increases probability while keeping your risk tighter. The third and most refined method is the liquidity sweep plus structure shift. Price takes out equal lows or highs, sweeping liquidity, then immediately reverses. Once that reversal breaks structure or shows a change of character, that's confirmation that institutions have just entered. That's your cue to follow. Now let's talk stop losses. If you're using a limit order, place your stop just beyond the extreme of the zone. That gives the trade room to breathe without exposing yourself to too much risk. But if you're using confirmation entries, like a break of structure or change of character, you can tighten your stop. Place it just below the low or above the high that caused the move. This improves your risk-to-reward ratio and limits unnecessary loss. Finally, we move to take profits. Keep it simple. You have 3 solid options. First, target the next opposing supply or demand zone, areas where price is likely to react. Second, use a fixed risk-to-reward ratio, like 1:3 or 1:4, to maintain consistency. And third, scale out. Take partial profits early and let the rest run. That way, you lock in gains while still giving the trade room to go further. Want to take your trading to the next level with order blocks? In our last video, I explained 3 advanced strategies using order blocks. Click here to watch and see how these strategies can boost your trading. You'll definitely want to check it out, and trust me, you'll like what you learn.